and every cedi in your wallet. Now, just recently, the Bank of Ghana actually cut their policy rates from 15.5% to 14%. Now, on paper, that actually sounds like a relief, cheaper loans, more business activity, more spending, and all of that. But the question many economists are asking is that, was this the right move at this time? Was this the right move at this time? And we all know that global oil prices are rising. Geopolitical tensions are also adding pressure to our import dependent economy, and timing also matters. And so that is what we're having today's conversation. We want to look at the trade-offs, the risk, and also the potential impacts of this decision. And we'll break it down in plain language, how it affects loans, investments, and day-to-day finances. My guest is an economist, and he joins us this morning for the conversation. We're looking exactly at what this really means. His name is Dr. Nunoo. He's an economist, and he joins me over the phone lines for this conversation. Doc, good morning.
Good morning.
How are you doing, sir?
I'm fine, thank you.
Great. Good to have you. Thanks so much for making time to join us.
Thanks for having me.
All right. Okay, so, well, first of all, in your view, do you think that the decision by the Bank of Ghana was more forward-looking, or maybe just reactive to current economic pressures?
Yes, so that question can be answered with time. If we are lucky enough, because there is high uncertainty, we are not too sure when the war is ending and the actual impact. Because if, for example, we are able to protect the Strait of Hormuz and shipment takes place, I mean, we have normal oil cargo moving, then we will say that was forward-looking. But if, God forbid, it remains closed, then the war escalates. Then Bank of Ghana should be lashed for taking that action. So actually, whether it was forward-looking or it was a hasty decision, who be told at the end of it all, or after a month or two. However, that decision was in line with our policy direction and the focus of the 2026 budget. So I think they took the right decision. However, how the judgment will be will depend with time. Only time can tell.
So you are one of the few people, I mean, the people who actually, or the economists who actually believe that it was the right decision at the right time. The reasons that they were giving, do you think they are valid?
Actually, I'm not even paying attention to their reasons. I'm paying attention to my own reasons they should do that.
Okay. And what are those reasons?
Based on my assessment, the reasons are that, and let me say that we also come back to the negatives. Things don't go well, but or the possibility that it can also thwart some of our efforts. But for now, my reason is that, number one, I have already hinted that we set clear policy direction for ourselves, that the economy has been stabilized well enough. I mean, inflation that used to be 23% is now about 3.3%. That is key. That is a very important aspect of fixing monetary policy rate. And I will come back to that. I will explain why it is so. Because then anytime we talk about these things, we have to talk about real interest rates. As we speak now, real interest rate is 10.7. That is referencing the monetary policy rate, and the inflation now. Because anytime we economists or investors are monitoring and analyzing things within the economy, we use real interest rate, not the nominal one. Because the nominal one could be very deceptive. Now, it's when you adjust nominal inflation that you get to have the real interest rate. And as we speak now, if we compare inflation to nominal monetary policy rate, we are going to get a very positive figure. That is 10.7, which is positive enough for us to do what we are doing now. So when inflation is about 10% and monetary policy is about 30%, you don't have enough room to adjust things. But when there's that huge gap, that huge positive gap, then obviously you still can come down. I mean, the monetary policy rate, as we speak down, can even come down, and we're still going to have that positive gap, which makes us more comfortable as we reduce it. However, let me finish my earlier point that we said without equivocation or any ambiguity that we have been able to stabilize the economy. It is now left with recovery, and we have recovered. It's now left with transformation and job creation. So if we want to transform and we want to create jobs, that basically means that we need to expand. And you cannot expand the economy when you are increasing monetary policy rates, because that makes the cost of borrowing very expensive, or borrowing very expensive, or it makes the cost of borrowing high. So when you come down, then borrowing becomes cheap. And so people are able to borrow and spend. Once people spend, it boosts economic activities in the system. And it also affords the private sector and even public sector agencies to borrow and expand. So that if I have a company, I can easily borrow and set up other branches, or even expand my current plants and employ more. So if you want to transform, if you want to boost economic activities, if you want to create more jobs, it's only wise that you ease the monetary policy. And what they have done is in line with our policy direction, the focus of the 2026 budget. So I don't blame them at all. I think that they have done what they need to do. It's only that there is much uncertainty in the system.
Exactly.
And we need to pray that things will not go against us.
Exactly, because so what is running through my mind is that, I mean, you're saying that we've recovered. Some people actually believe we are still recovering, though. But I mean, the general narrative is that we've recovered thus far, and so as a result, things have to move on, like you said. But shouldn't we be looking at what is happening? I mean, geopolitically and also externally?
Yes.
Because I followed, sorry, just before that, because I followed the conversation, I mean, or the address by the Bank of Ghana governor, and most of the things he spoke about were domestic stuff, and those were the reasons they are giving for that. I'm sure they will bring out the individual reasons from the members of the committee, but for now, generally, his address spoke largely on things that are happening domestically, inflation and all of these things. That is actually leading to where that decision that they took. And my question is, shouldn't you be looking at global or external factors?
Yeah, so obviously you may have to first look at your macroeconomic space domestically, and then you may also look through the external lens. But the point is that Ghana has, let me state that the IMF own threshold, if a country has international reserve of 3 months import cover, that is okay. That economy is safe to withstand or resist shocks. Ghana has well over 5 months import cover, which makes us even go beyond the bank of the IMF threshold, and that means that Ghana has enough reserves to handle external shocks. For the sake of those who are listening to us that may not be economists, what I'm trying to say is that the external shocks may work through the exchange rate. Apart from capital flight, and even with capital flight, there's a way to handle it. But obviously, when you talk about external shocks, probably you mean as in capital flight and exchange rate issues.
Yeah.
As for imported inflation and the like, sometimes there's less we can do about it. But then the best way is to make sure that you are planting import substitutes and you are helping domestic infant industries and other boosting economic activities to reduce imports. But as it stands now for the Ghanaian economy, based on what you are saying, you only mean capital flight. When I say capital flight, I mean the probability that investors will draw their money from Ghana and invest elsewhere. And it happened during the COVID-19 and the Ukraine war. The government then were not able to articulate the transmission mechanism well, so people did not get them. But then, obviously, capital flight is one of the things, and also exchange rate deterioration because we are net importer of refined oil. But this is it. If you have enough reserves, then you can use that to augment the supply of FX, foreign currency, so that your currency will be stabilized, like the Bank of Ghana has been doing. You remember the latter part of last year, the economy was supported with about $1.5 billion just to stabilize the city when the city attempted to deteriorate.
Yeah.
Now, in the same way, because we have more reserves, if there is any major shock, the Bank of Ghana can easily intervene. And that is not wrong, because the Bank of Ghana is one of the major mandates of the central bank is to stabilize currency, our currency for us.
Yeah.
So if the currency is fluctuating abnormally or galloping, then the Bank of Ghana will have to intervene with our reserves, and that is normal. People will call it artificial. So should we stand there for things to get out of hand? No, especially when we have reserves, more than 5 months import cover. At a point in this country, our import cover was just about 3 weeks. Around 2022, 2023, early part of 2023, we had just about 3 weeks of import cover. And the Bank of Ghana balances, remember, were negative, into negatives. And so, but we still survived. That probably is one of the reasons that we went to IMF. But now we have about 5 months cover. And so we have enough to manage the situation in the meantime. And also, if it has to do with, capital flight, it's about the government assuring the people, assuring investors that Ghana is safe and doing giving our economy proper publicity and doing proper marketing. That can curtail any possible flight. And indeed, if the assurance is there that we are going to do what is needful for investors not to lose much or for investors not to withdraw and go and invest elsewhere. And for the sake of time, if I want to explain the capital flight bit, probably I'm not too sure whether you become comfortable with your time. But basically, I think that we have enough reserves to manage the situation. However, it will depend on the length of the war. Length up in time,
right,
and the level of escalation. Because if, for example, more and more refineries within the Gulf region, the Middle East, are to be bombed, and the war should drag for several months, then obviously it could mean that we are going to exhaust our reserves beyond our imagination. But that is not the fault of Bank of Ghana, because Bank of Ghana is not in charge of the war now. So for now, you can only assess the situation based on what is happening, the prevailing macroeconomic conditions. And I must say that at any point in time, there could be shocks. You see, because at a point it was COVID-19, at a point it was Ukraine and Russia. Now we are talking about Iran, US. Okay, when America invaded Venezuela and captured their leader as if we're catching Christmas chicken. That one, nobody could predict that America could do that. So as for the shocks, there's little we can do about it, but we can always plan and move on with the current prevailing macroeconomic conditions.
Okay. All right. Anyway, so are you saying that at this stage of our recovery as a country, our priority should be accelerating growth, or we should be consolidating macroeconomic stability? Where do you stand?
For how long are we going to consolidate macroeconomic stability? Now, our inflation is as low as what prevails in the UK and Scotland and the like, 3.3%. Well, are we saying that people should not get jobs to do? Because see, it's an obvious fact in economics that when you target inflation, you sacrifice employment. It's commonsensical in economics.
Right.
Look, it's only a liar, someone who is not trying to be fair, that will say that reduce inflation and at the same time create more jobs. And sometimes I laugh when successive governments try to portray the fact that they've been able to reduce inflation and actually creating more jobs. It's a lie. So this current government has done so well with macroeconomic stabilization. But let me tell you that in terms of job creation, the government should accept that it has not done much. So it is now time to create jobs for the youth. Don't you hear people saying that they are not feeling the macroeconomic gains in their pockets?
Well, lots of people
because
say that.
To bring inflation from 23% to 3.3% means that you tightened the economy, you mopped up, you mobilized excess money balances in the system. You did not allow people to spend much. And if you are selling cocoa and coffee and people are not buying, how do you produce more? And do you even tell your child to come and support you there? Because even the half cup you took to the market, no one is buying. But if you take it there, they are buying, then you need more hands. You are likely to establish another cocoa at the next junction. Cocoa must be on a junction to get publicity. So once they buy, businesses grow, businesses thrive. So if you tighten the economy by way of targeting inflation, obviously you sacrifice employment for that. And the government has done so well. In terms of the macroeconomic stabilization, it is time for us to boost economic activities and to create jobs. And that means that you need to expand, so that contractionary monetary and fiscal policy bits must be relaxed. Now we should be talking about expanding the economy, and someone's bomb in Iran should not stop us from doing what we need to do, except that we must tread cautiously.
By treading cautiously, what do you mean?
Yes, I mean that like the way they are going, we should not just think that because we have enough reserves and all is well, we can just start reducing the monetary policy rate by heart or anyhow. And then the Minister of Finance can also start spending, because when you see it's between monetary policy and fiscal policy. Sometimes the monetary policy could be going right and the fiscal policy could be going left. And during the previous regime, it happened. And sometimes both could be going in the wrong direction. Like, for example, when the government wants to spend and spend and spend without measure, and the Bank of Ghana also decides to do excessive monetary financing just to help the government through the Ministry of Finance to spend, then the two of them are just heading towards the country would start experiencing abnormal inflation like it had happened in 2022. But sometimes the Bank of Ghana can decide that, well, you want to spend, but we don't think that it is prudent for you to spend, so we are not going to do excessive modesty. We are not going to finance your deficit excessively. And that will force the government to do the right thing. And in some cases, like what we are seeing now, both the Minister of Finance and the Bank of Ghana can say that we want to contract the economy. We don't want to spend because we want to stabilize the macroeconomic condition, the situation of the macroeconomic situation of the country. And so, at a point, that yields results. But for the sake of the people, for the welfare of the people, for the betterment of the people, you need to also look at ways of boosting economic activities and creating more jobs. So for me, if you look at all the indicators, where the government picked it from and where we are now, commonsensically, it is time for us to expand and create more jobs. And that is the reason I'm saying that whatever the government is doing now, whatever monetary policy we are seeing now is in line with our policy direction. It is in line with the focus of the 2022 budget. And remember, I am always not comfortable with setting budget and throwing it away. It used to be in the past that we draft good budget. On paper, everything looks smooth. When it comes to implementation, it is something else. But if we want to stick to the 2026 budget, that even the theme, when we finish, revisit the theme. The theme is about transformation and job creation. So if you want to transform and create jobs, you cannot tighten the economy. So for me, I think we have not enough room. For example, I told you that the gap between real interest rate, the gap between interest rate and nominal interest rate and nominal inflation gives us very positive real interest rate. And we thought that gives us the latitude to do what we are doing.
All right, so I just checked the theme. I think it's resetting for growth, jobs, and economic transformation. So, it supports all the things that you're saying. But, I'm also looking at the risks that could actually... What exactly are the potential risks from, the global rising oil prices and also the geopolitical tensions? What are the risks that may rise?
I like your sense of reasoning. With it, but I like the fact that you have brought it on. Now, you see, these are the possible risks. Number one, oil prices. Ghana is a net importer of oil, refined oil. It means that when the oil we send out and the one that comes in, if we match it up, we owe. It means that we need more than we send out. So if prices go up, when we cancel the revenue we get through oil and how much we pay for oil, we'll be in deficit. It means that when prices of oil move, it will go against us. And it also means that we need more foreign currency, especially dollars, to be able. That is what Iran wanted to avoid. That they wanted to work against US dollars so that people will not use dollars to buy oil. Remember, they gave a warning that if you deal with any ship that is of US ally or US is passing through the Strait of Hormuz, they will blast it. But if it came from any other country, they may allow it to pass. And they also caution about those who trade with US in dollars. So they just wanted to break the dollar dominance in the global system after the Second World War. And in fact, that is what has given US the strength, because most people trade in US dollars. Though we buy from China, we realize that people still use dollars to even import from China and vice versa. And so that is the system now Iran and its allies wanted to break. But it's almost, the US is too strong for some of these things to thrive, because they also come with harsher retaliation. But that is just by it. So, we still need dollars to import, all things being equal. It means that if oil prices move up, because we are net importer of refined oil, we need more dollars, and that will affect our currency. And also, there is this possibility of imported inflation. For example, US total import from China, about 21%. That is the highest. And so, and China also depends on oil from the Gulf region. I mean, the Middle East, especially Iran. So if, and in fact, one of the secret reasons U.S. is so much interested in stopping Iran is to destabilize, to disturb China in a way, and Russia. So the reality is that China also imports oil cheaply from Iran, because Iran has always had issues with the U.S. and Israel. And so they are comfortable supplying to China. And that makes the oil cheaper to China. And so China to buy from there. Now, if because of this war, China's domestic product experiences inflation. I mean, they experience inflation domestically in China. Because we import about 21% from our total import from there, we will bring the things very expensive. So our importers will have to increase their prices so that when they sell it here, they can go back for more and make profit.
Yeah.
So that inflation is imported inflation. There's nothing we can do. It's not because our economy has done it. Our economy can remain intact. Our macroeconomic environment can remain intact. But the only problem is that where we are importing goods and services from are experiencing inflation. So we have brought down the inflation here. And that is another risk. And now another risk is also capital flight. And that happened during the Ukraine-Russia war. But the government then was not able, in my view, their communicators were not able to explain well. I don't know whether for technical reasons or whatever it is. But this is how it works. You know, capital flight talks about withdrawing investment from one country and probably taking it to another. So let's say we have foreigners and even Ghanaians outside buying, investing in Ghana, either through stocks or bonds or whatever, any other investment in assets in Ghana. Now, they do that because probably interest rate in Ghana is high as compared to other investments prevailing in Europe and US. Now, what happens is that when US, for example, is experiencing high inflation, and let's say their inflation is 2%. I need you to pay careful attention for the sake of our time because I may not be able to go back. So let's say inflation in the US is about 2%. Now, interest rate there is about 5%. Inflation moved to 5%. Now, because of the war, they are bombing activities and high uncertainty. Let's say inflation escalated, and normally U.S. experiences that when they go for war and stuff, things start getting expensive. So inflation moves to let's say 5%, equaling their interest rate. Now, what the government of U.S. will do is to increase the interest rate so that investors will benefit. Because if inflation is the same as interest rate, there's no incentive to save or to invest.
Yeah.
So then the government can, let's say, move the interest rate just hypothetically to, let's say, 10%. Now, when interest rate moves to 10%, that makes interest rate in U.S. very high. So the man in UK who invested in Ghana and is getting, let's say, 10% in Ghana cities, in Ghana here, will think that, why don't I
invest in the U.S.?
Go and invest in the U.S. I will get more profit from there than to let my money. So now they will start withdrawing their investment from Ghana to U.S. because interest rate in U.S. has gone high.
Yeah.
And there are people whose only way of making profit is this. They study interest rates across the globe and start switching. And that's their way of, they will be sitting home and they will be enjoying money. And you'll be asking, why are these people rich? But that's all that they do.
They do, right?
They like to invest in financial assets. So that will bring about capital flight. And so also when maybe because of imported inflation and the likes, our economy is highly uncertain. People don't know what will happen. They may also not be comfortable allowing their money to remain here, especially when they remember the haircuts I will pay, I will not pay, restructuring and all those things. I mean, a sensible investor will go like, as for these Ghanaians, they can easily give you a haircut if this war should bring a problem to them. Money. So they will draw their money and save in a country that has not been giving people haircuts. So that is also to do with the capital flight bit. So these are the basic risks associated with what is happening. So I said that it is only time that will justify this decision or otherwise. So if everything goes well, the war does not escalate beyond our expectation, then Bank of Ghana will be applauded. But if for some reason Uncle Trump decides to do his thing, then the war escalates and drags on for a long time, then people will start blaming Bank of Ghana. But within me, I know that they did what is needful, and we don't have to blame them for anything, even if things don't go with the way we expect, because that is life.
All right. Please Please hold on for me. Let me just announce the phone lines in case anybody is listening to us and they want to be a part of the conversation. If you just tune in, this is Business Breakfast on Z101.9 FM with me, Nate Trebi Hammond. And this morning, we're talking about exactly the timing of the monetary policy rate cut. The Bank of Ghana actually cuts their policy rate from 15%, 15.5% to 14%. And that's what we're talking about this morning. My guest is Dr. Nunoo. He's an economist and he's helping us make sense of exactly what he thinks about the decision of the Bank of Ghana. If you just joined, you're free to send us a WhatsApp. It's a very interactive show. Feel free to send us a WhatsApp on 0544-321019, 0544-321019, and we'll read your messages for you. You can also call us on that same number, or call us on you can call us on 0303956641, 0303956641, and then we give you the opportunity to ask your questions or make your comments on what we are discussing this morning. We're streaming live on Facebook at ZFMGH and on YouTube at Z Multimedia. Please drop a comment there and I'll read them for you as well. All right. So, Doc, let's continue the conversation. Now,
Sure.
All the risks that you mentioned, can't those risks actually offset the intended benefits of easing the rates in any way?
It's only a matter of time because it is uncertain. We are not too sure that is what will happen. So the reality is that it's like the way we live life. I mean, I don't know your background, but Christians believe that Jesus will come. But it doesn't also mean that we should not build and do our things. So that when he appears, we go with him. If he doesn't come, we are here. So it's the same thing. I mean, the war is ongoing. It could escalate. It could drag on for a long time, but nobody can tell. Today, they can end it. They can have ceasefire.
Yeah.
And if you let me tell you one thing about Donald Trump, Uncle Trump is highly unpredictable. Remember, he was going to negotiate with Iran before we could say that he has already sent U-2 bombers there. So Donald Trump can say that I'm tired, let's ceasefire, and can also decide to continue. So as for that man, he's highly unpredictable. So we cannot say that because there is war. I mean, the war that it's not as if even Ghana is at war. There is war somewhere. We should not live our lives or we should not make decisions. I mean, life must go on, except we are 100% sure that this is what is going to happen. But for now, we are not too certain as to what would happen. So, yes, if things don't go well, these shocks could be enough. I mean, could be heavy enough to thwart, because we are talking about the fact that about 20% of oil, global oil, passes through the Strait of Hormuz. And so, yes, 20% shake-up is enough to cause mayhem. But what I'm trying to say is that it's a matter of, it's something that is so uncertain. And Ghana cannot remain inactive because there's war. I mean, Ghana must live its life. And so we will live if whatever will be, should be. But if we are sure of the way forward, then we act. But for now, I think because we still have a positive gap, or because our real interest rate is very positive, we still have that room to do what we just did. And I think it makes sense.
All right. Okay. Great. So beyond this part, what is actually happening now, I want us to learn something here. To what extent should monetary policy rates respond to external shocks versus domestic economic conditions?
Yeah, so obviously, the shocks would only affect price levels and interest rates on investment.
Okay.
Yes, because the inflation also triggers interest rate fluctuation. So yes, if, for example, because of the shock, prices are moving in the way I narrated, I talked about. Talking about it. You see, one thing I forgot to tell you is that the capital flight debt also disturbs your exchange rate, because most of the people wanting to invest in US will have to change their cedis into dollars. And that will put pressure on the cedis as against the dollar. So we realize that the cedi will start depreciating against the dollar. And so that is also the bit about that. So the Bank of Ghana would have to intervene by stabilizing general price level in the economy and also making sure that it works on the exchange rate. And this is normally the problem. So what the Bank of Ghana can do through its monetary policy is that it can, for example, if interest rates moves up, if general price levels go up, if there's high inflation, then the Bank of Ghana will have to increase the monetary policy rate so that interest rates will be high and people will be attracted to save or to invest instead of spend them. So right now, if Bank of Ghana, for example, should say that the treasury bill rate is 50%, my brother, just in a matter of if I put 100,000 there, in about 12 months time I'll get 150,000. So why do I have to spend? I'll go and put the money there. So the interest rate is used to trick people to put their money, to stop spending their money and to save it with either the government or in any asset possible. And so normally what the Bank of Ghana does is to increase the monetary policy rate. Once people stop demanding for goods and services, it's a basic economic sense that if, demand reduces drastically as against supply, prices will remain stable or even reduce. So once people stop demanding for goods and services, it will help stabilize the prices. So that is the rationale. And if the Bank of Ghana thinks that price has been stable enough, we need to trigger demand to boost economic activities in the economy, then the Bank of Ghana will reduce the monetary policy rate. So now, if things don't go the way we expect and price levels get high, prices surge, there's high inflation, the Bank of Ghana will reverse the reduction in monetary policy rate. Yes, increase it, and then that will ease the pressure on goods and services because people will stop demanding, and that is the normal expectation that people will invest more. Now, interest rate on treasury bills is very low. About, I think, around 4 point something, even for 91 day below. So that is very low. So if you increase it even to 9%, the demand for treasury bill will go higher, and that would be that people are sacrificing consumption for investment. So these are some of the dynamics.
Okay. All right. So essentially, what I'm getting from you, if I get you well, the Bank of Ghana has room to be able to, cut their rate. And that particular strategy is to say that, okay, let's cut it while we still continue to, because the war doesn't have direct effect currently. So let's drop it and monitor for some time. If we begin to see things go in a particular direction that we don't expect, or that is going to affect us, then we can reverse the whole we can reverse what the cuts that we actually did, isn't it?
Yes.
Okay. Yes. All right. Okay. So now let's look at the impact on businesses and households. Now, practically speaking, how will this rate cut actually transmit into the real economy? You spoke earlier on about how people are saying that they don't, they can't feel the impact of the things that we are seeing in the economy, the progress that we are saying we've made in their pockets. How will this particular rate cut transmit into the real economy? Will businesses and consumers actually feel the difference now?
Yes. So now that reminds me, there was a lady friend of mine who is a director in one of the public organizations, and she came to me that I should endorse a loan form for her. And I said, but not too long ago, I endorsed one for you. She said, hey, my boss, interest rate has now reduced, so I want to take advantage of it. And that's just, people do that. Once you reduce interest rates for, let's say, 30% to about 15% or 18%, people think that borrowing is not expensive anymore, and they would like to take advantage of it. So households can now borrow more and spend. And that is about borrowing. Private organizations, agencies would also find reasons to borrow more because it is not too expensive to pay back. Another bit is that normally when interest rate, the monetary policy rate is high, and for example, and I always believe in even interest rate on treasury bills because the average Ghanaian would like treasury bill. If interest rates on treasury bill, for example, goes high, or the monetary policy goes high, banks and other financial institutions even find a reason to invest in treasury bills instead of giving the money to the private sector, because the private sector goes with risk, and sometimes receiving it becomes very difficult. There is always high bad debts, loans that have gone bad. So then the bank, if the interest rate is okay on treasury bills and other government assets, then they will quickly invest. That is how come we even have to do financial stabilization fund around 2022, 2023 when there was the debt restructuring, so that financial institutions, insurance companies, and other institutions that had invested with the government in terms they are struggling, so that in order not to fold up, the government will help them with something. So if the interest rate reduces, like it has reduced drastically on treasury bill now, the banks want to make more profit. So instead of investing in such cheap, low interest yields on assets, they would rather want to give it to the private sector. So if they are going to get, let's say, 4.4% on 91-day bill, they will give it to an investor, a private sector, who will give them, let's say, 10% for 3 months and make more profit. So then they are forced to give the money out to the private sector, which would in turn transform into job creation and consumption and all of that. You see, so the monetary policy rate and its associated interest linkages help to monitor the money balances in the system, the liquidity in the system. And the lower it is, the more expansionary it is. It's likely to expand the economy. And the higher it is, the more contractionary it is. It's likely to tighten up the economy by reducing demand, general demand for goods and services. So these are the mechanisms. So now what they've done is supposed to increase consumption because people are likely to borrow to buy more because they feel it is cheaper to borrow. And businesses are also likely to borrow more because they think that they can easily pay back and not fold that for paying high huge interest rates.
So you expect commercial banks to meaningfully adjust the lending rates?
Yes, the last time the MPR was reduced, they did marginally. That has been the problem. There's always a disjoint. The Bank of Ghana reduces its monetary policy, and these banks don't react. But when that happens, it is very dangerous because then it thwarts our policy direction. Bank of Ghana does not do that for fun. Bank of Ghana does that in order to influence macroeconomic direction of the economy. So once Bank of Ghana acts and the banks or the financial institution refuse to respond, there's a problem. It means that there is no benefit to the ordinary Ghanaian.
Yeah, but
the Bank of Ghana.
Sorry, but they argue of some structural factors that actually limits their the impact really.
Yes, they may be right. They may be right, but the Bank of Ghana must, have a dialogue with them and see what the bottlenecks are and remove them. Probably they can have a bipartisan approach to it. So the Bank of Ghana, the Minister of Finance, the leadership of the banking sector, and other financial institutions can be on a round table and discuss the challenges we have. And the government will do it if it has to do with legal bottlenecks, if it has to do with political bottlenecks, if it has to do with probably some public structure, like let's say credit rating and improper background checks for people who are borrowing, because then the Ghana card must be efficient, must be reliable. They must have access to some database, be able to verify the background of the borrower and all of those things. So the government might have a role to play. The Bank of Ghana can also have a role to play, probably through their reserve ratio, apportionment, and all of that. So if we have a bipartisan dialogue, then their challenges will be highlighted and with the hope of removing them. Then we can have a better policy reaction so that when the Bank of Ghana comes down, they also come down commensurately. So I think that we cannot just leave things to be the way they are. When even monetary policy rate goes down, nothing happens. It doesn't really help anybody.
Okay, so all right. So if the bank fails to adjust, it's going to affect the growth that we're trying to push for, right?
It will be meaningless. It will not make any economic sense. It means that we'll be where we are. Nothing happens. And so it's likely that the bank will even make more profit, but not the other. It will not transmit through the economy. It will not settle down. So it's when they also respond that it moves down to the ordinary Ghanaian. Because then the monetary policy rate is actually the rate at which banks borrow from the central bank. And because they are into profit making, they also need to make profit. When they borrow from the Bank of Ghana overnight or whatever, the Bank of Ghana gives an interest rate. They also add on and give it out to their customers, and the difference is their profit in a very simplistic way. But if you borrow cheaply from the Bank of Ghana and you refuse to reduce the interest you are giving to the borrower, it means that you will only make all the profit, but it will not go down. And that will also not attract a lot of people from borrowing. So then it stays within the banking sector. The profit stays with the banks and nothing happens. So, the Bank of Ghana must have a way of making sure that their policy travels down the rest of the sectors of the economy.
All right. So we spoke about businesses more broadly, but I want us to look at SMEs. What does this decision mean for them? I know that some SMEs are already struggling with high borrowing cost and all of that. What does this mean for them?
But it's more important for them because do you know that some of us, when we go to the bank to invest, we are able to bargain with the bankers for a good interest rate.
Yeah.
I don't know whether you've tried it before. Yeah. So
I know some people who have.
Yes, I have personally done it a couple of times. Like
right.
I come to you, I said that what is your interest? You tell me let's say 15% on fixed deposit. I said no, I want 20%.
Yeah.
Then we bargain. So when you have, let's say, 200,000, 1 million, you can easily bargain with them because they need it. So then they give you that freedom to bargain with them. In the same way, if you look at it, I don't want to mention any. Okay, let's say ZFM is known. So then ZFM, the CEO goes to borrow. I mean, because you are known and you have more facilities assets, it's likely you can even bargain for reduction.
Yeah.
But that SME, that small guy from the university who is now starting his business and even doesn't have a collateral, and then they are helpless. So these things even help the small and medium scale enterprises because they don't have much. They don't have stronger bargaining power. So then whatever prevails is what they are going to get. So it helps them rather than the big ones. As for the big shots, sometimes the banks even chase them for loans and they are able to even slice their interest rate by half. So, I mean, your question is right. I mean, it helps startups and these small enterprises.
Is there any chances that this could create opportunities for certain businesses while putting others at risk?
You mean the policy rate?
Yeah.
Monetary policy rate cut. Yes, probably. When interest rate goes down, those who are interested in investing in financial assets, they lose somehow. But those financial assets, if you invest in financial assets, it doesn't really help the economy. It doesn't really expand the economy. Let me give you a typical example. It is like deciding to put your money into treasury bills instead of using it to create jobs. Now, ZFM has employed a number of people. Now, if ask yourself, the ZFM financiers, the owners, could have used the same money to buy treasury bills. So if ZFM owner has used the money to buy treasury bills, do you think that those who went there could be working there now?
I would not have a job.
Exactly. So if the more people invest in these financial assets, I mean, it can pay job creation and like that, except that we are fortunate enough for the government to say that I'm going to create direct jobs with the money they have brought to me through treasury bills. But how many times does the government create jobs directly like that? Right. So we need the private sector to be creating more jobs than just investing in financial assets. So those are the ones that will lose. But if they feel that they are losing, they are likely to withdraw the money and use it to set up businesses and employ people. And that will also help the economy.
Right. Okay. Let's touch on investor confidence and then we can go. So what signal does this move send to investors? I mean, both domestic and international, about our policy direction as a country?
Well, you see, once they start rating you positively, I mean, Fish, Moody's, Bloomberg all have been rating us because of the way we have been able to stabilize the economy.
Yeah.
And that boosts investor confidence. And also, for some time now, prices have been relatively stable.
Yeah.
And investors can now predict what is likely to happen by the end of the year in December because we've been stable. The trend has been sustained. So you can easily, when it fluctuates, the interest rate goes up, comes down, inflation is here, and you are not too sure. So once the system has been stabilized, investors have that reliability in the economy to do what they want to do. So for now, I think that there's high investor confidence, and that is even the reason why ACNUA is still the way it is. Because if people think that they can't trust your currency, obviously they'll be holding dollars instead of keeping cedis because they feel that the store of value function of your currency is not being performed well by your currency because of inflation and the like. So I think that for the fact that exchange rate has been the way it is, it's also a sign that investors are confident in the economy. And also, the posture and attitude of our president, the way he speaks, his mannerism, and the people, the government machinery, the way they've been behaving. Let's cut down expenditure, unnecessary travels, let's do the needful. If you are corrupt, all those talks assure people that this government is going to do something serious. And if they should continue this way, then investors will see some seriousness in us and will continue investing in that. So it's a couple of things. It all come together to define what we call investor confidence.
All right. So, Doc, thank you very much. Maybe my final question to you. So looking ahead, if the global conditions worsen over time, how flexible is the MPC in reversing course?
You mean if the global condition does what?
Yeah, if it worsens.
If it worsens?
Yes.
Oh, okay. All right. So if it worsens for a uncomfortable discussion, but the Bank of Ghana and the relevant stakeholders and reverse it. No doubt about it. Reverse it. So, in the past, it used to be around even 27% or so.
Yeah.
And it moved from 14%. I remember during the first term of the previous regime, it was around 14%. It moved up until it got to about 27%, if my memory serves me right. So, nothing stopped. We brought it down ourselves. If things are not working, we can take it back.
Can go back.
We don't need IMF or World Bank roundtable to reverse it. It's happening in Accra here. We just sit down and reverse it. If you get it.
Yeah, I get it.
That is it.
Right. But how fast could policy react to sudden shocks without causing any market panic?
Yes. So normally you can only see it when the harm has already been done, because you may have to physically see the disturbance. So, for example, if you see that the Ghana Capital Service brings up its month-on-month inflation figures, and you realize that inflation is moving up, it gives you a signal that the economy is getting sick. So then you have to react. So, for example, if now we have inflation of about 3.3%, if next month it shoots to, let's say, 4%, they know that there's something wrong.
Yeah.
Or probably they break down, realize that transportation is what is accounting for high inflation. They know that oil is giving them a problem. Then of Ghana would have found a way out of inflation basket. So these are the things we consider. Obviously, like you only see it when the harm has already been done, but you can easily put in a reverse measure to remedy the situation.
Right. Okay, Doc, thank you very much for your time, and thanks so much for sharing your insights with us this morning. We're really grateful.
Thank you so much for the privilege.
All right. Please do enjoy the rest of your day.
Same day.
Okay. All right. So that was Dr. Evans Nunoo. He is an economist, and he joined me this morning for our roundtable discussion. We've been talking about, we spoke about the monetary policy rates cuts, to 14% from 15.5%. And he says that it's actually the right thing to do. Especially because our budget says, our budget's in the direction of growth, and also we've been able to recover quite well as a country. So we can come down a bit, and then as and when we see that the global conditions are worsening, what we can do is to be able to bring it back. And so it is not wrong for the Bank of Ghana to drop or to cut or slash the MPR in any way, and he supports that particular move by the Bank of Ghana. Just that we have to be cautious, according to him. All right, so that is how we wrap up today on the Business Breakfast on Z101.9 FM. It's been a very good conversation. Dr. Evans Nunoo, our guest this morning, has helped us greatly, and thanks so much to him, and also to you for listening to us right from 6:15 till now. We're really grateful. Tomorrow we are back again. Tomorrow is Wednesday, and so we'll bring you the midweek edition of the Business Breakfast on Z. Still some business conversations and things that affect you directly as a Ghanaian, and that's what we'll be talking about tomorrow, God willing. So please don't go anywhere. Stick and stay with us right here on Z101.9 FM. Continue to enjoy our shows, and we'll meet again tomorrow. My name is Nitrebi Hammond. Until we meet tomorrow, please take care of yourself, and when you think Ghana, think Z. Up next is A Brighter Side with Jerry.